Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice or raw sugar in New York. The main pattern here since September 2024 had been, I suppose still is after a fashion of sorts, the breached and seemingly repaired dark blue September to December 2024 bear channel. That's currently 1527 to 1868. However, in recent times, the bright pink late September 24 to mid-January 25 bearish Andrews picture, which I drew 14 weeks ago, is a better contender in showing the bearish angle of attack. And on this one, we are today in between the middle time below, currently at 1550, and the upper time above, currently at 1806. Then in a more immediate past, well, since mid-May, we have the newly drawn bright green bear channel. And that's currently 1586 to 1663. And that's being tested right now at both ends. So it'd be very interesting to see what happens. It looks like we've got a daily key reversal on the cards. However, there is also complementing these bearish patterns a larger, longer-term bright red November 23 to September 24 bearish shift pitch hook, which has also been pretty good at showing the bearish angle of attack over a longer time frame. On this one, we are today, as we have been since mid-April, close to the bright red middle time, this time just below it, and that's currently at 1680. The bright red middle time along with the bright pink middle time had helped hold up the market on a number of past occasions, even though they are bearish patterns. However, all these patterns are still indicative of a market pushing lower. I said 7 weeks ago, and I quote, "We've also seen support below from about 1750 down to about 1650, though it is a declining support once again, and once past the pink middle time, the support begins to dissipate." End of quote. Now, a key support that had been broken is now acting as resistance, though it is now some distance away, is the important overhead level 1809. This is because it is the interesting 50% absolute Fibonacci line for the whole of the 21st century. We are now well below this 50% Fibonacci line. Now, this Fibonacci line, along with the 50% Fibonacci line of the April 20 to November 23 move at 1859, had in the past worked together as significant supports and an eroding force for some of the bearish incentives. Now, they will act as capable overhead resistances. But I'm wondering if they really do need to do that, as the pressure is, well, even despite today's action, still lower. And as I said earlier, the supports for what they are declining. We have this month pushed down through the April 2017 high at 1716, the May 2017 high at 1659. And we've been testing the February 2020 high at 1591, all quite old. Now, I also went back 8 weeks ago, back to my monthly charts in a further effort to get a handle on what technicals were operating here. And the major pattern I saw there, which is still working, is the double top, an Adam and Eve type that had been constructed throughout 2023. This had already reached its primary target at 1880, and 2 weeks ago prices reached the harder to reach secondary target X down at 1630. The green bear channel is the one to watch for the immediate future as to where we go now. Well, we have three longer term bearish patterns that are right now holding dominance. It was, as I said 2 weeks ago, and I quote, "It all depends if prices can properly break down through the bright red middle time and then exploit the move lower." End of quote. And that's still the case now. You see, below the February 2020 high, which we have tested today, well, we have nothing apart from these three bearish patterns until the March 21 low at 1467. So watch that bright red middle time in the immediate future. Ice Europe white sugar in London. After all this time, there still continues to be three features of this market to bear in mind, and actually an interesting one for today as well. Plus a new, more recent one. The first is the obvious and broken, though now back to being repaired, purple late September 24 to mid-February 25 descending, expanding wedge pattern. That's currently 498.92 way off the bottom of my daily chart. This pattern has more than the requisite 5+ necessary touches made by January this year, and had been severely tested on the top side both late February and mid-April. enough that I would not necessarily classify as a descending wedge pattern anymore after February, though I am still keeping an eye on the extension to the upper trend line. The break upwards in mid-March reached up as far as the February 2017 high at 565 even, and in the process formed a double top. The primary target was reached mid-April, and the secondary, much harder to reach target X, down in the 464 area, was reached 2 weeks ago. On the way lower, I asked you 9 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25, recently finessed bearish shift pitchfork. We are right now in between the overhead upper tide, which is currently 548.60, and the middle tide below, currently at 490.30. This is a very shallow pattern, and the more market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market started utilizing the bright pink middle tide first as an attractor, riding prices lower in a shallow glide until 3 weeks ago, when prices broke free on the downside, finally eroding to nothing the congestion between 489 even to 490.10, which has been quite a narrow band of support that had previously been breached but not broken back in late January. It consisted of the April 2017 high at 489.10 plus congestion from late 21 to early 22, including the quad bottom back then, along with the bright green neckline extension to the April to June 2021 head and shoulders top. That's currently at 490.80. Now we're at the moment below all of these, and they have become resistance, but given what's happened today, I'm going to have a quick look and see what the lows have been. Right, so the low of last week was at 460, the low today is at 460.10, so there's not a chance of a weekly key reversal at the moment. Now, thus looking lower down, just in case, the May 2017 low at 468.90 and the 2025 low at 462.60 would seem obvious supports, which is what the May 2017 low did 3 weeks ago and the January 25 low did 2 weeks ago, and again today. Now, 3 weeks ago, when looking at the new supports below, I said, and I quote, I'd also looked at the August 21 low at 442.60, but these supports are quite wide apart, though we do have congestion at 456.60. But then we have little until that August 21 low, and would then have another potential issue, and that's to regard the whole of the 2025 action as a possible rounded top pattern. End of quote. Now, I added 2 weeks, and I quote, more on this pattern idea after we see target X at 464 even. End of quote. Well, we now have seen 464 even, so it's time to look at some potentials. As it's way too early, even despite today's action, it's way too early to look at targets, as the market has not generated that move as yet. Thus, an initial upward potential will be up in the 522 area, for harder secondary potential up in the 565 even area. On the downside, a primary potential will be down in the 449 zone, so it's not too far away, but with a harder secondary potential down in the 361 zone, or in other words, at around the bottom of my current daily chart. More on this as it develops. Sugar white premium spread. Some interesting gyrations here in recent times. Now, 10 weeks ago we had a weekly key reversal up, though it was also ended up as a weekly indecisive doji cross. Yet at the time with the highest close since mid-July last year. A week later, so 9 weeks ago, we had an even more dramatic immediate countering key reversal down, pushing and closing below the declining gold long moving average, currently at 102 even. The week after that, so 8 weeks ago, we had a counter to the counter combined bullish Harami and bullish closing white Maribozo. This was followed the week after, so 7 weeks ago, by a third countering bearish dark cloud cover pattern and bearish double. We then had the following week an inverted hammer pattern, which is a dubious pattern as it is traditionally seen as a bullish reversal pattern. However, the data indicates differently in that between 6 to 7 times out of 10 it acts as a bearish continuation pattern. The market this time followed the data, though it did it cautiously, with the following week being an indecisive spinning top. But it was also week 2 and a 2-week bearish separating lines pattern, followed by another inverted hammer that saw the market once more follow the data rather than tradition, leaving us 3 weeks ago with admittedly a lower but still indecisive doji cross and the lowest low and low close since mid-February. 2 weeks ago, we had another hammer pattern, but also a bullish engulfing pattern, which to be honest wasn't that hard to do as the previous week was an indecisive doji cross. But then last week we had an expansionary bullish white Maribozo, verging on being a bullish long white Maribozo, and enough of a move higher to push up over all the moving averages. This week we have already moved higher and are set to challenge for the first time the overhead dark blue upper tine, currently at 119 3/4, of the newly drawn 2 weeks ago, mid-April 24 to mid-April 25, bearish Andrews pitchfork. What happens there, should we reach it, will decide if this pattern is worth following or whether I should draw a shallower bearish shift pitchfork for the same move.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.